This is Business Weekend with Ross Greenwood.
Hi there and welcome to Business Weekend. I'm Ross Greenwood. It's great to have your company today. Coming up on the program, this week's decision by the Trump administration to review the $300 billion AUKUS defence agreement will send a shudder not just through government but through Australian defence contractors who are gearing up right now to win business. But behind this is a sad reality. The Australian Defence Force too often overlooks local ideas, local companies in favour of inflated equipment and supplies from overseas.
The real risk to AUKUS isn't from the US, it's from Australia, and it's from the bipartisan failure of successive Australian governments to properly fund and invest in defence.
And in a little over 2 weeks' time, the government's $2.3 billion plan to subsidise batteries for homes and businesses will start. But there's a serious concern, unless it's administered and monitored vigorously, that it will turn into a dangerous free-for-all, just like the Rudd government's rollout of pink bats.
And so even that small percentage of unsafe systems is big enough to create real worries about what the scheme might do with the tidal wave of what's going to happen around all these installs.
And the stock exchange operator, the ASX, is struggling right now. New companies seem to be avoiding it, and private equity businesses are taking over more and more public companies. Now the corporate regulator, ASIC, wants to help encourage more companies onto the public markets. The only thing is that ASIC is also investigating the ASX for poor performance that led to outages last year. So we speak with the ASIC chair, Joe Longo.
Why do we have markets? Because we need them to allocate capital. Why do we have capital? Because we need to build things. We need to invest in things.
But let's start with the economy, which, and there's no doubt about this, it's struggling to grow right now. Some suggest lower interest rates will help. And our next guest, Westpac Chief Economist Luci Ellis, said more of those interest rate cuts are coming. The Prime Minister, Anthony Albanese, thinks a roundtable with business about productivity might help. But in reality, previous roundtables have just been a waste of everybody's productivity. So what will get Australia's economy moving again, especially in the likely absence of a minerals and energy boom, and with our population rate now falling? Luci Ellis was the Assistant Governor of the Reserve Bank in charge of its economic outlook. So this week I asked her if a roundtable on productivity was simply a waste of energy.
Ross, I think one of the things we need to be careful of is to avoid buying into this idea that productivity is something the government does to you and that you can't possibly become more productive unless the government does some kind of reform. And typically people go to the tax system, which has very little linkage with productivity. I mean, the country with the highest levels of reported productivity, the United States, has a much sillier tax system than ours. So what we need to focus on is the things that are known to boost productivity, and that's changing your business model, getting rid of all the cruft in your own business processes, adopting new technology, investing in new capital, investing in the skills of your own workforce. These are things we know actually does something to boost productivity. And it's in all of our hands to do that. We've got to stop waiting for governments to do something to make us more productive. It's a mindset that's very peculiar to Australia. After all, we have a productivity commission, therefore it must be a government responsibility. But we've got to get away from that. There are things governments could do to avoid getting in the way of improved productivity. But in the end, if you look at the performance of the Australian economy over the last few years, the area where living standards really are created, which is the market sector, and particularly for the purposes of domestic inflation pressures, the non-mining market sector, productivity growth's actually been okay.
Okay, so then could I put to you that maybe it would be better if the Prime Minister had announced a competitiveness summit and not a productivity summit? Because Australia, quite clearly, is lagging in competitiveness, which is driving capital overseas, and also means that there's not enough capital coming into Australia.
Australia has a huge pool of savings, and in fact our domestic savings is now so big in the superannuation system that it can't keep filling up the Australian stock market because it's already too overweight. So it does look for opportunities offshore. But one of the things we know from our customers is there's a huge number of opportunities that the equivalent pension funds in other countries are more than happy to diversify into here. I'm actually not too concerned about competitiveness in this country. When countries aren't competitive, it's mostly a statement about their exchange rates. And at the moment, our exchange rate is pretty much fair value against most of our trading partners.
But what about when it comes to industrial relations, when it comes to our tax system, when it comes to energy systems? When I talk to the chief executives of many big companies, they say they're driving capital into the United States in particular because they get a bigger bang for their dollar there as compared with Australia. Isn't that a national crisis?
The cost of energy is going to be an impediment. And I think when people are using the United States as a comparator, what they're really talking about is actually the cost of energy. So for energy intensive activity, at the moment, the US is looking like a better opportunity. And that is absolutely something that, ensuring that we have cheaper energy, abundant energy, that we're not making it too hard for ourselves, is something that we need to do in order to ensure our competitiveness. But we actually have a very flexible labour market because so much of our workforce is on contract or is working second jobs or indeed is on an individual contract. Most of the labour force, the plurality of workers are on individual contracts, not on enterprise agreements or even awards. So, again, we're looking to the government to change things in order to find opportunities. Meanwhile, the industries that have opportunities are taking them. I mean, a lot of people aren't aware that we have now a $7.5 billion export industry, so bigger than copper, metal, bigger than aluminium, bigger than barley, and it's called software licensing. It's only $1 billion shy of the wheat export numbers last year.
And that's a highly productive industry, right?
It's a very highly productive industry. And, each of those individual products, if you think about it, Canva and Atlassian and WiseTech and a few others add up to an awful lot of sales. We're actually pretty competitive relative to United States business service providers because the US dollar is overvalued. And that means Australians who speak English and are well educated can go and do management consulting or engineering consulting, all of those little bits and pieces of business services and still undercut an American competitor working in America at the moment. We saw the same thing at the turn of the century.
Okay, then take me to economic growth, because at the moment it's only literally bumbling along just above recessionary rates. There is a per capita recession, pretty much it's been going for 3 years now. So standards of living are going backwards. So these are not necessarily great economic numbers. The question is whether at some stage they revert back to their long-term normals.
We are expecting a gradual pickup in growth and in particular gradual pickup in consumption. Nothing startling, but we are expecting it to get to 1.5% growth.
It's about half its long-term average, right?
That's right. And we are expecting it to go higher, into the twos in 2026. And the reason we had such a squeeze on consumption and therefore on private sector demand is because we have had such a squeeze on household incomes. The combination of inflation and higher taxation of bracket creep did that. Over recent quarters, we've now seen household incomes start to increase. People are now got a bit of breathing space. They're able to save a bit more, they're able to spend a bit more. The pickup has not been as quick as what the Reserve Bank has been expecting, and that comes to the evolving view about the near-term part of the Australian economy. But we are looking for a handover from very weak private sector demand growth, picking up a little, and picking up some of the slack as some of the growth in public sector demand rolls off, because we know that there are a number of things that have been boosting public sector demand, like the fact that they're paying for a lot of our electricity bills at the moment, like the fact that the NDIS is ramping up very quickly, and like the fact that state governments have been doing a lot of infrastructure build. Well, the rebates on electricity are all rolling off. The NDIS growth rate will normalise everyone's trying to make that happen. And as each of those big projects that the state governments are running complete, they're not replacing it with something else in the pipeline. So, the public investment profile is going to come down from here. So all of that is pushing in the direction of slower growth in public demand. One of the things we've been worried about is whether that handover from public demand to private demand is shaky. But what we're seeing is that will happen, and so that will actually be a better situation for the Australian consumer. It won't be a boom, it won't be happy days, but it will be much better than they have been feeling over the past couple of years.
You've also put out your latest rate calls this
Correct,
week,
yeah.
And that also plays into this whole narrative of the slow economic growth.
That's right.
And inflation reverting back to the range, and even perhaps below the range of where the Reserve Bank might like to set, or the midpoint at least of that range. So where do you sense it goes to from here?
Well, that's exactly right. Our view of the near term is that our existing call that they'll keep on hold in July and then move in August entirely aligns with what we're seeing in the current data and what the RBA is saying about its intentions. I mean, the board would not have put the words cautiously and predictably in the minutes if they were planning back-to-back cuts. That's just not central bank speak to then suddenly go and do a lot. And the markets are pricing in a cut in July at the moment, but we just think that's getting a bit ahead of themselves. At the moment, looking at what the RBA thinks inflation's going to do, they've got trim to mean inflation flat as a pancake at 2.6%. That's telling you they had the choice to put a couple of 2.5s in there and they didn't. That was a choice, and they're saying they're still worried about inflation risks. What's changed is we've been doing some thinking about what slower population growth means for housing costs, what we're seeing in the labour market's going to do for labour costs, what productivity's doing for labour costs, and indeed, the fact that we are going to see this slowdown in public sector investment. All of those things it tipped our own inflation forecasts down below 2.5%,
which gives space
next year.
Right, which gives space for even more rate cuts down the track.
Correct. And so what we've done is we've added 2 more cuts, but not till next year. Now, maybe the timing's different, maybe things turn out differently, but we think based on what we're now seeing and what we now think will happen to inflation, once the RBA gets to the end of the year, they will be saying, oh, crikey, actually inflation's lower than what we thought. That means we need to do a little bit more. They're not going to rush it. They're not rushing to get to what they think neutral might be. They're very circumspect about what they think neutral might be. It's very imprecisely estimated. But, they recognise that there's room for them to reduce the restrictiveness of monetary policy. And the way they're going to do it is cautiously, predictably, as the data allows them. And that says a moderate pace of rate reductions, but 2 more than what we thought last week.
Luci, Ellis, always good to chat to you. Thanks for your intellect. Thanks for your insight today.
Thank you very much, Ross. Always a pleasure.
The decision by the US Department of Defence and President Donald Trump to review the $300 billion AUKUS defence deal with Australia and the UK should send shockwaves through our military and indeed our whole community. It's clear, and we know this directly from Defence Secretary Pete Hegseth, that the US wants Australia to increase defence spending from around 2% now to 3.5%. This financial year, Australia will spend around $51 billion on defence. If America's aims were to be fulfilled, that would be $89 billion in today's money. So where would the extra $38 billion a year come from, we all might ask? We know that phase 1 of AUKUS, and though through the administration selling the US Virginia-class submarines, is being questioned by the current US officials like Elbridge Colby, who has long criticised this AUKUS deal.
I think AUKUS is really important. It's really valuable. I think the question will be in the implementation. I mean, there's a lot of moving parts, because it would be great if there are more American submarines, more Australian submarines that are more highly capable. That is a win-win, but we can't sort of take it for granted and pocket the gains like we've already achieved that.
There's another issue here, and that is that local defence contractors, for all their know-how and innovation, find it almost universally difficult to sell their ideas to the Australian Defence Force. Some ply their ideas overseas, others eventually go broke. But if the US succeeds in getting AUKUS changed, it's likely even more of our defence equipment in the future will come from just one place, and that's America. Gary Slater is a former US Marine who's Chief Operating Officer at the Australian Defence Consultancy Group, which helps military contractors ready themselves for AUKUS contracts. And he joins me now from Canberra. Gary, many thanks for your time. I just want to start with this review of AUKUS. In your mind, does this make sense that phase one of AUKUS is really questioned about what its structure is and exactly what Australia's getting out of that?
Yeah, Ross, thank you for that great question. This certainly is dominating the headlines today, and I think that it certainly is a sensational news story, but I think Australians should be reassured that this is normal. Any incoming administration will review the policies and the plans that have been put in place by the previous administration, and that's exactly what governments here in Australia do. Anytime a new government comes in, they conduct their own defence review, and they want to ensure that the policies that are in place and the plans that are there to support those policies are going to be what is in the interest of the nation and the way the government has their worldview and how they want to see their policies outlined. So I don't actually think that this review is shocking and alarming, but it does send a clear signal that at any time there is policy risk for the future of AUKUS. But I would like to point out that the real risk to AUKUS isn't from the US, it's from Australia. And it's from the bipartisan failure of successive Australian governments to properly fund and invest in defence. And now AUKUS Pillar 1, the conventionally armed sovereign nuclear submarine program, threatens to cannibalize the rest of the defence budget. There is a real risk and a real concern among experts in the defence policy community and in the defence industry that the AUKUS Pillar 1 program will just take up the rest of the defense budget. And this Labor government in particular, it appears like they're using AUKUS Pillar 1, which is not really anything in the short term. You know, the first Virginia-class submarine is not scheduled to be purchased or delivered until 2032. That's several election cycles from now. So the concern is that there's a lot of talk about AUKUS and its symbolism, but what is Australia's defense policy now for the period of the highest risk? And what is the government's position towards Australia's defense industry, how to prepare them for a potential high-intensity conflict in the Indo-Pacific region?
Okay, so because one thing I constantly hear is Australia, as you have said, is ill-prepared. And one of the reasons for that is it simply rejects any local homegrown technology that might help our defence forces in favour always of American gear. It suggested to me that no bureaucrat working in our defence forces was sacked for buying American equipment as compared with buying it from somewhere else.
So there's a lot of rhetoric and a lot of understandable aspiration for Australia to have a sovereign defence industrial base. But the dirty secret is Australia doesn't have a sovereign defence industrial base. Something like 70% of all defence acquisition spending goes towards US programs of record, and the largest defence contractor in Australia is BAE Systems, a UK company. So the primes and their international global primes dominate the Australian defence industry. And the rest of the industry, those small and medium enterprises who do produce real, innovative, productive, and capabilities that could be used today are often locked out of the contracts. There's a tendency for defense to want to deal with a few large players and not hundreds or dozens of smaller players. There are some great initiatives like the Defense Trailblazer program, and there are grant funding, but it's just not enough. So I'm a free market capitalist. I believe in small government and small business, and I don't believe that industrial policy is usually the right answer. There's one exception to that rule, and that's in defense policy. If Australia wants to be serious about having a sovereign defense industrial base, it has to invest in it, it has to fund it, it has to go out and procure and purchase from local Australian companies, and they're out there. They're producing incredible kit, drones, counter-drone technology, long-range strike. There's all kinds of great capabilities that are out there that Australians can produce here, but the government needs to be aware of that, and they need to be willing to invest. And this current government hasn't shown any inclination to prioritize defense spending. Everything else is a priority, and the nominal increase in defense budget doesn't keep up with inflation. It doesn't keep up with the loss of purchasing power of the reduction in the Australian dollar. It's simply not enough, and every expert outside of defense has called for the same thing: increased defense spending and funding, and an increased prioritization and allocation towards building a real sovereign defense industrial base here in Australia.
So I've spoken to defence contractors, and indeed some of those innovators that you have spoken about that could be genuinely helpful to our Australian Defence Forces. What they tell me is what you have said is they are simply ignored by the local ADF. Instead, they, if they're to survive, have to go overseas to find the scale that can actually acquire their technology, because in many cases otherwise they won't get developed.
That's absolutely correct. The US defense market is the largest defense market in the world, and the US Department of Defense is the largest procurement agency in the world. Any Australian small, medium enterprise or entrepreneurial startup that wants to scale quickly has to look at the export market. There's simply not enough demand coming from Australia, and although everyone in the defense ecosystem wants the ADF and Australia's warfighters to be equipped with the best equipment, the best kit that they can get, the default answer is to go overseas to purchase proven programs of record that will achieve interoperability with Australia's allies, primarily the US. And there is goodness in that. There's a lot of logic behind that, but there's also a lot of risk. And so if Australia wants to really capitalize on the intellectual capital, the entrepreneurship and the innovation that's here in this country, they need to be much more focused on finding that talent, using programs like the Defense Trailblazer program that ADCG is a proud sponsor of to get that talent to market, bridge that pathway to commercialization. And then if you really want to create jobs, you're going to have to provide the resources. And if you really want to create that sovereign defense industrial base, you're going to have to trust local content, and you're going to have to prioritize that over proven programs of record overseas.
Okay, because doesn't Ukraine, in its battle with Russia, doesn't that really show us what homegrown innovation, homegrown technology, what it can do and achieve in outcomes that are tailored for your own nation?
That's exactly right. I'm hoping that those are the lessons that are being learned, that across Ukraine, small enterprises and startups have moved rapidly to scale to use commercial off-the-shelf technology, to integrate supply chains with friendly nations, and to use every means available to rapidly produce fieldable and combat-credible equipment that the ADF could absolutely purchase today. There's no reason why this country doesn't have mature long-range strike, loitering munition, armed drone, and the mini and the inexpensive drones that are out there that are changing the character of warfare as we speak. It's proven. We see it everywhere around us. I'm hoping that the ADF is learning those lessons and that they're willing to take a risk on local Australian companies and resource them so that they can produce that equipment here in Australia, where we can assure the supply chain and we can promote and support that sovereign Australian defence industry.
Well, it's certainly a lesson, no doubt for our ADF, but certainly also for our government as well. Gary Slater from the Australian Defence Consultancy Group, I appreciate your time here on the program today.
Thanks, Ross. Have a good one.
Well, coming up, corporate cop ASIC is promoting more companies to list on the ASX. At the very same time, it's part of an investigation into shortcomings of the way the ASX runs the market. After the break, we speak with the head of Australia's corporate cop, ASIC Chair Joe Longo. Thanks for being with us here on Business Weekend. Well, right now, there's a serious question mark over our stock market operator, the ASX. The exchange wanted to change its operating system called CHESS for a blockchain settlement system. We've talked a lot about it here on these programs. But the project, which was worth hundreds of millions of dollars, failed spectacularly. Even worse, late last year, the ASX system collapsed, leading to the exchange to unexpectedly close down. Now, this sparked an inquiry into the ASX by the Reserve Bank and by the corporate regulator ASIC, which raises questions about the ASX's ability to manage our most sensitive market. But this week, ASIC came out with a new trial to allow companies to fast-track their way onto the ASX, to float, in other words. So ASIC is on one hand promoting the public markets, at the same time it's investigating the competence of the ASX's manager. So this week I caught up with ASIC Chair Joe Longo to gain his assessment of public versus private markets.
Well, the ASX is a critical entity as part of our economy, and the way to think about this is the way we think about the big banks, or the way we think about the superannuation funds, They're all critical parts of our economy, but that doesn't mean regulators like ASIC can't hold them accountable for things that aren't going so well. Now, in the case of the ASX, we all have an interest in a healthy public market. Our superannuation system, our savings system, all sorts of things turn on our markets functioning well. But where an entity like the ASX is not meeting our standards around operational resilience, around cyber security, around a whole range of other issues, then it's our job to hold them accountable.
Okay, so you hold them accountable. The question, I guess, that many people might argue in the markets and outside, is the ASX as an organisation the right organisation to run our public stock markets?
At the moment, we have confidence that the ASX is running a functioning market. They are a unique entity in our economy, having said that, between us and the Reserve Bank, we have identified a number of operational issues, resilience issues, their approach to technology that is simply not good enough. And so we're holding them accountable for improvement in those areas. But at the same time, they still have to run the stock exchange, just as we expect our major banks to continue to provide basic services to all Australians. We've had a number of issues with the major banks over the years, and that doesn't mean the banking system's in trouble. It simply means that those entities have to be held accountable for meeting standards and expectations.
But when ASIC and the Reserve Bank put out its statement saying it was investigating the ASX over those outages and its concerns about the CHESS system, you said our actions underscore our increasingly deep concerns with ASX's management of the CHESS system and will continue to consider further action. That's not really a vote of confidence.
You can expect ASIC to continue to have those concerns. We are considering further action, and what that'll look like is evolving. We have a court case against the ASX in relation to misleading statements to the market that we allege were made in February 2022. We are conducting an investigation into the outage from last December. But these are things we should be doing, Ross. This is what accountability in a system where the rule of law requires entities like the ASX to meet certain standards. We're holding them accountable. And while we're doing that, they have to continue to run the stock exchange.
Okay, they're continuing to run the stock exchange, but as compared with, say, going back about 4 or 5 years ago, when there were hundreds of stock market floats, IPOs, in other words, companies coming to the public markets, this year there have just been 4. Now, Virgin is to come, to be honest, that's a big one. But the question is whether other operators and business operators have also lost some confidence in the ASX.
Well, this is a big question, what's going on with de-equitisation and stock markets. So when you really step back, this phenomenon of fewer listings is actually a global phenomenon. We're seeing it in the US, we're seeing it in Hong Kong, UK, Australia. So the critical question is what's going on here. And I think one of the narratives is not, I don't think, can the ASX handle listings? I think the bigger question people are asking is, well, is there something about our regulatory settings, about our listing rules, about the way in which we approach regulation generally that's putting people off, so to speak.
So the question there is whether life is easier as a director,
as a private market,
as a business owner in the private markets versus the public markets. But that's not a healthy thing for our superannuation funds, for private investors, to not really have the choice of those businesses that are held in private hands.
Well, I should hasten to say we're not convinced by the regulatory argument. In fact, our research shows that the 2021 was the second highest year for listings in Australian history. And in 2022 was also a very big year for listings. So there's something else going on here, and we've spoken to a range of market participants. Most of them are not saying to us, "Oh, look, if you tweaked the listing rules in this particular way, if ASIC changed its approach in this particular way, that this would see a big increase in listings on our public market."
But this week you did change the rules. You basically created a 2-year trial to be able to create a fast track for listing on the ASX. Is that a response to the lack of listings? Is that a response to those concerns that there's too much red tape to get a company onto the ASX?
That's called good regulation, Ross. I said a year ago when we launched our market cleanliness report that if market participants had an actionable idea, I would run with it. What's an actionable idea? It's an initiative that's within my gift, or ASIC's gift or power to provide. So over that period, we've had several submissions, and one of them we were able to announce on Tuesday some tweaking of the beginning of the listing process.
So this is something you can do without having to go to Parliament?
That's right. And the other thing to bear in mind is even the investment bankers will tell you there's no silver bullet here. I think public markets are here to stay. We want healthy, robust public markets, but there's no silver bullet here. It's a combination of circumstances that will lead to an entity wanting to publicly list. What I've said repeatedly is that I don't want ASIC to be part of the problem. Our job is to facilitate confident participation in our markets, to ensure fair, orderly, efficient markets. And if there's a problem there that I can help with, that where there are things we can do to make access to these markets more confident, more efficient, then of course we're going to do that.
Are you concerned that the biggest participants in our public markets, which are the industry super funds, which are now massive institutions in their own rights, that they themselves are imposing rules on public companies and public company boards of directors and effectively putting another layer of red tape and governance over what you already do?
That's not a phenomenon that I would articulate in the way you're putting. I think the superannuation funds are probably the most significant new phenomenon in our markets in a generation. We're looking at a 4 trillion Aussie dollar plus sector, and they're running out of investable assets. Well, have run out of investable assets, broadly speaking, in Australia. Between a third and a quarter of our public markets is superannuation money. As we all know, increasingly they're investing in other markets, in particular the US. So I think the superannuation part of the story is really important to understand and is evolving. So how we think about what the superannuation funds should be doing with our money and the governance standards there and where and how they're engaging with the private markets, the issues they're encountering, all these things are very interesting to ASIC and to the market, and the work we've been doing is in part focused on trying to understand that.
Okay, because the issue of private markets versus public markets is liquidity. You can't suddenly, if you've got a big private equity position, cash that in at a very short notice. With the public markets, despite the price falling, you can. Now, if there's ever an issue inside a big superannuation fund, does it concern you that many of these investments that are being made by the big superannuation funds now are largely illiquid?
Liquidity is one factor when people talk about private-public markets, but I'd hasten to say in the superannuation funds that they have a very sophisticated approach to matching having to pay out super with the assets that they're managing.
And at the moment they've got massive cash flows coming through the door because of compulsory superannuation.
So that's a very complex, nuanced picture.
The problem would be if something went wrong with one of these super funds and investors wanted their money out.
Ross, I think the critical question is what's going on in these markets, and liquidity is one aspect of why someone might want to be in the public market, because they can see good price discovery, there's a lot of transparency, and you're right, there appears to be a lot more liquidity in the public market than the private market. But I go into this, ASIC goes into this with a very open mind. It's not just about liquidity. In the end, what we really want to do is encourage markets. Why do we have markets? Because we need them to allocate capital. Why do we have capital? Because we need to build things. We need to invest in things. And people need to be able to do that in order to save for retirement and create wealth. So these are the fundamental drivers. And so I go back to that big question. It's not on ASIC to run the markets. Our job is to understand what's going on there and to identify issues or problems and say to ourselves, is that an issue or problem that ASIC has something to do with, can do something about, or is it something we need to call out? And the market has to do something about it. So I get a lot of questions about where all this is going to land, and maybe we'll come to that in a moment. But the markets are constantly evolving, they're organic, and in the end we all have to remind ourselves why they're there. They're there to allocate capital.
But also then on top of that, the superannuation funds themselves, which almost act in some ways holier than thou in their own morals and ethics, as you've pointed out, themselves have had lapses in recent times that you're holding them to account for.
Well, the superannuation sector has been enormously successful at investing the money. Let's be credit where credit's due. It's a widely admired system, what we have in Australia, and I've never said otherwise. But with that comes enormous responsibility. And what I've said to the superannuation sector, you've got to lift your game with the governance standards. And what does that mean? It means taking a hard look at your data, your systems, your processes, your infrastructure, and be very focused on what you're supposed to be doing for members, your true customers. So yes, we have a growing sector. It's been very successful investing the money, but that's just the beginning. We need to be ready to pay out the so-called decumulation phase and to provide the basic service that members expect. And that requires investment in data, systems and processes. And this is where the sector, frankly, is behind. It's playing catch-up now.
Joe Longo, always good to chat to you. Many thanks for your time.
Thank you, Ross.
After the break, the rushed installation of pink bats was a disaster for Australia and for the then Labor government led by Kevin Rudd. Now the Albanese government is seeking to fast-track the installation of household batteries, and similar safety concerns are being raised. Thanks for your company here on Business Weekend. Now, one of the Albanese government's key election policies is a $2.3 billion cheaper home batteries program, which is due to start on July 1, so in just a couple of weeks' time. The government claims this plan will cut the price of installing a battery by 30%, a saving of $4,000 for each battery installed, it says. The government also claims more than 1 million batteries will be rolled out by 2030, so less than 5 years' time. But there is a valid question in all this. Who will install these batteries? And is there a danger corners will be cut in the rush to take advantage of the government scheme? Already, fire authorities around Australia are issuing warnings. And if this all sounds a little bit like pink bats and Kevin Rudd, even some in the battery industry right now are worried about this. Daniel Lazarus is one of the founders of Industrious Services Groups, which pivoted from installing solar systems to servicing them. He now audits solar and battery systems and is seeing an alarming pattern of substandard installation and unsafe compliance. And he joins me now. Daniel, many thanks for your time.
Thanks very much.
How serious is the problem that you're seeing out there right now?
I mean, it's pretty serious. I mean, from our perspective, we've audited thousands and thousands of systems and batteries across the country over the last even as little as 12 months. And have seen a material amount of these batteries and solar systems, which are either substandard or a small percentage of being unsafe. And so even that small percentage of unsafe systems is big enough to create real worries about what the scheme might do with the tidal wave of what's going to happen around all these installs.
But as I think about this, it's in businesses, it's in homes, so houses, but also in apartment blocks.
Correct.
And if you have something that goes up significantly, it's going to cause a serious problem for government, for this policy, indeed for the community at large.
I mean, it will. I mean, and let me just stress, the architecture of this particular program is sound in regards to the accreditations that installers need to have, the standards that exist around the industry. But the problem is with this huge influx of rebate schemes, what will happen with the inevitable influx of businesses that will come within the industry to try to take advantage? And what are they going to do to try and maximise the rebate that they obtain? And how will they take advantage or at least avoid dodging a lot of these elements that are required to receive the rebate, that being standards?
Okay, but what you're telling me already is that even though there are protocols and standards that have been put in place, and presumably which were learnt from the lapses in the installation of the Pink Bat scheme, you're already seeing unsafe systems. You're already seeing lapses in standards. So that spells a significant danger if you're trying to roll out 1 million batteries over 4.5 years.
Totally. And the challenge is in some states, there is an element of mandate around specific inspections. In most states, there isn't. And in many cases, the inspections that exist today are in a minority of systems and are completely voluntary.
Okay, so can I take you back on that? So in other words, a mandate that a system has been installed, that somebody comes out to check that the work is safe and to check that the work has been done properly, so it reduces the danger, the risk that there could be a fire in the future.
Correct. And that's what we're really advocating to industry, is around how do you make it such that either all systems, or at least the majority of systems installed by every installer that's taking advantage of this rebate scheme, is getting physically inspected. But in addition to that, sending the message out to consumers to say, hey, these aren't set and forget batteries and solar assets, just like your cars, just like HVAC and air conditioners, just like anything. You really need to take it upon yourself, if it is indeed not mandated for every system, to ensure that your battery and solar asset is inspected by a third party.
Because there is potential risk there that consumers, businesses have to be aware of, but also that government has to be aware of. Because if you've got an inspection system, but you're not inspecting every one of those systems as vigorously and as often as you should, then that's where the potential dangers could lie.
Correct. I mean, with pink bats, for example, the rebate scheme essentially increased the number of businesses in that sector from 200 to more than 8,000.
It's flies to a honeypot, bees to a honeypot, isn't it?
Totally. And even when you're talking in that case, there was a few fatalities, less than 100 fires, but all it takes is a small amount of incidents to call the entire scheme into question, which for the pink bats, for example, it reduced it from 4 years to 1 year. And the last thing that I want to see is a scheme like this, which is meant for only good, for homeowners and for the distribution of energy, to be called off early because of these particular risks.
Okay, so I'm going to go back to that original number I quoted, which is $2.3 billion. That's the price of the rebate scheme that the government is going to put in.
Correct.
That is the honeypot, as it were.
Correct.
That's what everybody's going to try and come for, because consumers also will see 40% discount on the installation of a battery. Thumbs up, that's a great thing for me. I think I will do that. The question is, who installs it, what shortcuts they take, and therefore, as a result, is that work going to be inspected?
Correct. And you can have all the mandates that you have around taking as many pictures as you can, taking selfies as you can, making sure that you're accredited. But I guarantee you, with these incentives in place, there'll be people to find ways around them.
Okay, so just having a look at this, the lower range battery that might be installed, you're telling us is around $6,000. But then a higher range battery might be, say, $15,000. But then on top of that, it's about $11,000 to install. So again, this is not outside the bounds of a lot of households, and certainly a lot of businesses, to install this, especially with the discount that the government will offer.
Well, remember, this scheme is not just for batteries, it's for batteries and new systems. It's to replace existing batteries. You can add and upgrade existing batteries as well, but you can also stack on top of existing state-based schemes as well.
So in many cases, what you're saying here is it's a warning not just to consumers and businesses, but it's a warning to government to make certain that the safety standards are not only put in place, which they have been, you say, but then they're adhered to as this system grows out.
Correct. And it's around, yes, you've used the existing architecture, which is great, but then how are you going to use that existing architecture to handle this huge tidal wave of additional electricians or businesses that want to take advantage of this? And that's going to be a huge challenge. And I think these mandates that I've suggested will make a huge dent in reducing a lot of this risk.
Well, Daniel Lazarus from Industrious Services Group, it's a great explanation. It's a great danger. We'll stick with this as well because it's a really good story, and I appreciate your time.
Thank you very much, Russ.
Let's now turn to property markets, which are expected to continue to rise under the expected ongoing interest rate cuts that Westpac's Luci Ellis spoke about earlier. But for investors, the last several years of above-average rental increases might also have come to an end as lower migration rates take the edge off housing demand in our biggest cities. Australia's biggest online real estate site, REA Group, has just done its latest deep dive on rents around Australia. And its senior economist, Eleanor Craig, joins me now. Eleanor, always good to chat to you. This is not great news for property investors. Not great news for property investors who need every reason to go out and buy new properties right now.
Certainly we are seeing a bit of relief for renters, though, on the other hand. So rental conditions really beginning to ease from the incredibly challenging conditions that we've seen over the past, really much of the past 5 years, with particularly in Sydney, high-end rents falling in a number of premium suburbs and falling by up to $350 a week in some high-end pockets. And really what this is showing us is that, one, rental demand has eased, as you say, with with net migration pulling back, likely also rents reaching that affordability ceiling, with rents having surged over the past 5 or so years, really means that rental affordability has deteriorated incredibly, and renters quite simply can't afford to pay anymore and bid up rental prices. We have also seen that investor activity has picked up over the past couple of years, and actually rental investor activity is sitting close to a decade high.
So it's interesting because generally when interest rates come down, either the property values go up, which reduces the return, the rental return in percentage terms on those rates, the cap rate, if you like, that they normally talk about in commercial property. So what's happening now is that return, that cap rate, is actually coming down for 2 reasons. Number one, because prices are continuing to rise, but number two, because the actual rent itself is falling.
Yeah, so we're seeing that in some parts of Sydney, Queensland, Victoria as well, that rents are falling, but there are some pockets of the country where rents are still continuing to increase, and rents have certainly increased over the past year, even though they've pulled back a little over the past quarter in some suburbs around the country. So certainly when we're looking at rental yields, I guess for some they could be getting maybe less attractive with rents pulling back. But don't forget, we've seen a huge appreciation in rents over the past few years. For example, Melbourne, our most affordable capital city in which to rent, has still seen a close to $10,000 per annum appreciation in rents since the onset of the pandemic. And with property prices now appreciating as well, we are seeing that investor activity remains relatively robust, and certainly with interest rates set to increase further over the year ahead, we are expecting that activity from investors does remain at these relatively buoyant levels.
So riddle me this one. If the immigration rate, the net immigration rate is coming down, then rents are coming down. I totally get that so far. But then how does that go with the aspiration of the federal government and the Prime Minister to build 1.2 million homes between now and the end of the decade? It kind of, again, works against somebody wanting to go out and build more homes.
It's certainly a challenge, and we know that we've got a long way to go in terms of reaching those targets, although we have seen approvals and commencements broadly tracking in the right direction. We're certainly not where we need to be in terms of hitting that 1.2 million homes target. We're tracking at a kind of under 200,000 a year. We need to be tracking actually closer to the 220,000 a year mark. So we're still going to continue to have that supply deficit. And of course, you know, as you say, with the potential for rental prices coming back and immigration coming back, that might disincentivize some investor activity. But I think what we really need to see at the moment is activity from developers, and the key constraints there, of course, are higher materials costs, labour shortages.
Always great to chat to you, and many thanks for your time today. And that is it for the program this Sunday. Up next, all the latest news right here on Sky News. Business Weekend returns next Sunday. But of course, you can keep up to date with all the latest business news with our daily program, Business Now, 4:30 p.m. Eastern Time, and via our website, skynews.com.au. Thanks for your company today. I'm Ross Greenwood. We'll see you next week.